You're listening to Let's Talk Macro.
Brought to you by Bandhan Mutual Fund.
Hello and welcome back to Let's Talk Macro, everybody, the podcast on macroeconomics by Bandhan Mutual Fund. I'm Ahalya, keeping you company, and we've got with us, as always, Sreejith Balasubramanian, economist in the fixed income fund management team, here to dissect interesting global and domestic macroeconomic topics and events. Hi, Sreejith. Welcome back. It's been a while.
Yeah, I'm good. How are you?
I'm good. Thank you so much for being here today. And, since the last time we spoke, I think there's a lot that's happened. 2025 has been like the gift that keeps on giving, right, when it comes to macroeconomic shifts and things to keep an eye on, because global macroeconomics and geopolitics continue to drive financial markets all around the world. And, economic data in the US has turned milder. Tariff-related policies by Trump keep hitting the headlines almost every day, which is a lot to keep up with. And there's also other major economies that are seeing new developments. Uncertainty and volatility has also picked up, right? So in today's episode, we're going to look at the recent growth and inflation trajectory in the US, how this has impacted the US dollar, developments in Europe and China, what lies ahead, and what this means for India, for us back at home. So why don't we start with the US data? How is it on growth and inflation, and how has it changed recently? Any major changes since the last time we spoke?
The US growth data of late has been milder compared to how it was for a good part of last year. It's nothing alarming, just softer. And this includes overall consumer spending, expenditure on discretionary items, particularly construction spending and so on. In fact, survey-based data has turned down much more than actual hard data. So, various consumer confidence surveys, for instance, the ones by University of Michigan and the Conference Board, have all eased. Many of the subcomponents of these surveys, so there's the outlook on unemployment, income, and business conditions, these have fallen. Small business optimism is in fact down and uncertainty is up. And let's remember, these small businesses employ a large portion of the labor force in the US. And even if you look at CAPEX, that is a capital expenditure plans by businesses, according to multiple regional Fed surveys, they're all actually being down more recently, given the uncertainty primarily around tariffs. And over this, if you see, the US equity markets have also fallen, and that could, as we know, create a negative wealth effect on consumer spending. The other part of the story is on inflation. There, the readings have pointed to more sluggish progress on disinflation, which had been rather progressing in 2024. So, ISM manufacturing and services prices paid, which is the input cost that is. And similarly, various regional Fed surveys on manufacturing input costs, which are again closely correlated with the PCE price index there. University of Michigan 1 year ahead expected inflation by consumers again. And even the components of the latest consumer and producer price indices, which feed into the PCE, have all been higher. So basically, growth data in the US has been softer, with survey-based data being particularly weaker, and inflation data on the other hand has been strong.
Okay, and an interesting and important call out there about employment within the small business sector. Now, what do you think is causing this weakness, Sreejith? What has changed in the last few months? Is it too simplistic to, narrow it all down to Trump's policies, or is there something else at play here?
Yeah, you're right. It's not that simple. So first of all, let's not forget US has been growing above its long-term trend growth rate, with fiscal, immigration, private capex, and productivity being the main drivers. We've previously highlighted some of the offsets to US exceptionalism in some of our previous episodes, and these include the K-shape in the consumer situation, tighter financial conditions, and so on. Trump's policies have definitely created considerable uncertainty, mainly through announcements and even last-minute changes on tariffs on various products and countries. So, for example, he has so far announced tariffs on steel and aluminum imports, additional tariffs on all imports from China, and tariffs on imports from Canada and Mexico, which were then deferred. And he's also said reciprocal tariffs on various countries will be announced on the 2nd of April. And then he's also subsequently said that it could be more targeted than one might think about it. And these measures could invite retaliatory tariffs by other countries also, right? So all in all, this creates a very uncertain environment for investment and consumption decisions by businesses and consumers. So anticipation of supply issues and related price effects also drive economic behavior. Additionally, there is the government job cuts by the Department of Government Efficiency that is being talked about. The impact of this will depend on the actual scale of job cuts, although there is some early evidence by, for example, a regional Fed study which cited softer consumption areas with higher federal government employees. But the February fiscal data didn't show any material direct impact from this. So all of these factors are behind the moderation, and the Atlanta Fed's GDP nowcast for the first quarter of 2025 in seasonally adjusted quarter-on-quarter terms is now negative. That's it. Some of the recent data have held up pretty well, like non-farm payroll additions, job openings, core retail sales and housing starts. Industrial production was also good, but that was likely because of some tariff-related front-loading.
Right. So it's not just the Trump factor, but also a case of slowing exceptionalism behind easing growth data in the US. Now, with the weakness in multiple surveys standing out, the question also arises whether this translates to hard data. And Sreejith, given that we spoke about the US dollar in our previous episode, it might be useful to shine a light on, what the impact has been of all of this recent data on the strength or weakness of the dollar.
Sure. The US dollar has, in fact, been weaker in the last 1 to 2 months.
Okay.
One, given the softer US growth data, and the other reason is pro-growth policies by the Trump administration like tax cuts and deregulation haven't yet come through. But the back and forth on tariff policies and government job cuts have increased the uncertainty and the potential hit to growth. Markets' rate cut expectations by the Fed this year has also therefore increased, from its peak about a month ago. More recently, we've also had other major economies like Germany announcing debt-driven infrastructure and defense spending. In fact, other economies in the euro area are expected to increase their defense spending as a share of GDP as the US steps back. A possible Russia-Ukraine ceasefire is also positive for Europe. China is guided for a higher fiscal deficit, special government bond borrowing, and also unveiled a comprehensive plan to boost domestic consumption. So, domestic US data, Trump's policies, particularly on tariffs so far, expected Fed rate cuts, and developments in Europe and China have all sort of played a role in the recent weakness in US dollar, and it will continue to do so. And given foreigners had been investing heavily in US markets, riding on the exceptionalism trade with almost a unidirectionally strong dollar, the recent fall in US equities and the dollar together have caused quite a bit of pain there. So going ahead, of course, there will be volatility in the dollar too, as markets evaluate and reevaluate data and policies.
Okay, so a weaker US dollar there in the last few months after quite a long period of US exceptionalism and dollar strength. Now, very recently, we also had the US Fed monetary policy meeting, something that we were teasing in the episodes previous as well. So how is the Fed looking at all of these latest developments?
The FOMC left the policy rate unchanged at its latest meeting. But for 2025, that is this year and 2026, it lowered its growth forecast and raised its inflation forecast. But it did not change its rate forecast for 50 basis points cuts this year. It also cited unusually high uncertainty right now. Its base case is that the tariff price shock is transitory. The labor market is fairly in balance. Inflation progress has moderated and could be slow this year, although it's difficult to tell how much is only due to tariffs. It's its survey data, which is currently weak, like we discussed, does not always have a tight correlation with hard data. Again, it also decided to slow quantitative tightening, that is to reduce the pace of decline of its security holdings. But broadly, if you see, it cited uncertainty and lower growth and higher inflation projection, that's what it is about now.
Okay, so high uncertainty for the Fed and at least for the time being, no change in rate forecasts despite lower growth and higher inflation forecasts. I guess everyone prefers more clarity, on the situation, and central banks are no exception. They shouldn't be, rather.
Absolutely.
With that, Sreejith, I would like to ask about the recent developments back home. How are things looking for us in India, and what is the impact of everything we've discussed, if at all?
So in India, growth has been cyclically slowing a bit. We've discussed this before. Weaker credit growth, corporate tax collection growth, and the fall in imports of goods in February sort of point to this. Trade data also could have had some impact from global uncertainty on tariffs. But moderate domestic demand, excess capacity from China flowing to other countries due to US-China tariffs, and elevated uncertainty could have an impact on private investment and growth in general. That said, the RBI has really stepped up with provision of banking system liquidity. Again, we've spoken about this last time as well, and they just started injecting liquidity, but they've done much more in the last few weeks. After the FX intervention from October last year in the currency leakage, if you remember, the liquidity had eased considerably. More recently, the RBI announced multiple OMOs and the USD INR buy-sell swaps, and therefore core liquidity has turned positive. and it is estimated to stay so for some time unless a situation arises where RBI has to again heavily intervene in the spot currency market.
Okay.
In May, we have the RBI's surplus transfer to the government, that is the dividends, which will further add to liquidity, and also the drain from currency leakage is typically seasonally lower in the following few months after May. But that's it. RBI has some short dollar positions which it will have to unwind over a period of time, and that unwinding will drain some liquidity. But overall, the liquidity situation is now much better. And if you look at some of the other measures that the RBI has been doing, so it has restored the risk weights for commercial banks in NBFC categories of unsecured personal loans, which it had hiked in November 2023. And of course, at the February meeting last month, it cut the repo rate, that is a policy rate, by 25 basis points. And if you look at the data as well, so if you look at the CPI inflation data, that is cooled to 3.6% in February, so below the 4% target of the RBI. And it is widely expected to stay below 4% in March also, as food prices have been coming off. So in short, monetary policy is quite supportive, while fiscal is broadly consolidating. And even there within fiscal, we've had income tax cuts that was provided in this year's budget.
And how do you see the impact on India from the developments in the US that we just discussed?
Okay, so we've discussed before that in general, let's say a weaker US dollar is beneficial for emerging markets as it eases financial conditions. But we also have to see what causes the weaker dollar, because weaker growth in the US, which accounts for over 25% of global GDP, also impacts us. So today, US growth has shown signs of moderation and some global growth drivers have started to emerge elsewhere. So a weaker dollar is definitely welcome as it reduces policy constraints. But US growth outlook, the global growth in risk conditions, and therefore sustainability of a dollar move matter. And as we've mentioned, RBI will also have to unwind its short dollar position. So a good reason for the RBI to stay nimble for now, or continue to stay nimble for now.
Okay, with that, we come to the end of the conversation. As we can see, cyclical moderation in growth in India, but the RBI has really stepped up its liquidity provision. So hopefully that, bodes well for all of us. And let's also hope that the weaker US dollar proves beneficial. Thank you so much for joining us today, Sreejith. And before we end, as always, I'm going to quickly summarize the key takeaways for our listeners. First one, US growth has eased a bit, particularly survey data, while disinflation progress has slowed. This is likely due to moderation from above-trend growth and uncertainty caused by the Trump administration's policies. That said, some data, like that on the labor market, has held up well. The second point of note, the US dollar has therefore weakened in the last few months, given the moderation in US data, lack of pro-growth policies from Trump so far, expected Fed rate cuts, and developments in Europe and China. The Fed left its policy rate unchanged in March and also kept its projection for 50 BPS rate cuts this year, citing high uncertainty, although it revised down its GDP forecasts and raised its inflation forecasts. Its base case for now is that tariff price shock is transitory. And finally, in India, growth is cyclically moderating, but the RBI has stepped up banking system liquidity injection, and core liquidity is expected to stay positive in the next few months. With interest rate cuts in February and inflation cooling further, monetary policy should remain supportive. A weaker US dollar is welcome as it eases financial conditions and policy restraints for emerging markets. But US and global outlook also matter, and so the RBI should stay nimble. That's it for today. I really hope that this discussion was useful to all of you macroeconomic enthusiasts and anyone who is keen on understanding how the world of macroeconomics impacts all of us. Thank you, Sreejith, for being here.
Thank you, Alia.
All right, we'll catch you next month with another important rundown. But until then, bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.